Market Analysis, September 5th, 2025. Welcome back to Daily US Stocks, your daily dose of smart market insights to stay ahead of the markets. Today is Thursday, September 5th, 2025, and as Wall Street digs deeper into September, we're seeing major signs of rotation, sector divergence, and renewed economic jitters. With the Fed's September meeting just around the corner and volatility creeping back into the major indexes, let's break down everything you need to know to position ahead of the next big move. Part 1. Market Recap. September begins with a stir. September is historically the most volatile month for U.S. equities, and the first week has certainly lived up to that reputation. As of Thursday's close, markets posted mixed signals. The S&P 500 edged down 0.28% to close at 6,115, breaking a three-day winning streak. The Nasdaq Composite slipped 0.41% to finish at 19,720, led lower by semiconductors and profit-taking in AI names. The Dow Jones Industrial Average, however, posted a modest gain of 0.15%, ending at 41,950, supported by strength in energy and industrials. The Russell 2000 Small Cap Index dropped 0.72%, showing weakness in more economically sensitive stocks. The VIX rose to 17.2, its highest level since early August, signaling increasing hedging activity and risk aversion. What drove the moves? Mixed economic data is starting to confuse markets. This week's ISM Services Index came in hotter than expected at 53.7, suggesting the U.S. economy is still growing steadily. But August's jobless claims unexpectedly ticked up to 236,000, sparking concerns about labor market cooling. Oil prices surged to over $89 a barrel, the highest since October 2023, lifting energy stocks but also raising inflation fears. Bond markets reacted strongly. The 10-year Treasury yield jumped to 4.42%, its highest in 2 months. It's a push-pull environment. Stronger data keeps recession fears in check, but also reduces the chances of a Fed rate cut, and that's what's making traders nervous. Part 2, the Fed puzzle. Will they or won't they? We're now just 13 days away from the next FOMC meeting on September 18th, and the market is having trouble reading the room. After a summer of dovish expectations, the narrative is starting to shift. What the market is pricing in. Fed funds futures are now pricing in only a 25% chance of a rate cut in September, down from over 50% just 2 weeks ago. The probability of a November cut stands at 60%, while December remains the most likely timing for the first move at 72%. What changed? Resilient growth data, like this week's ISM Services print, shows that the economy isn't slowing as fast as some had hoped. Sticky core inflation remains a concern. Core PCE for July came in at 2.8% year over year, still well above the Fed's 2% target. And now, with oil prices surging, the risk of another inflationary wave is back on the table. Fed Chair Jerome Powell has maintained his data-dependent stance, but markets are starting to realize that higher for longer might really mean it this time. Part 3, sector rotation. Energy up, tech under pressure. One of the most noticeable themes this week is sector rotation. Let's break it down. Winners, the standout performer of the week. ExxonMobil, Chevron, and Marathon all gained 3 to 5% as oil surged past $89. The XLE Energy ETF is up 4.7% this week alone. Industrials benefiting from stronger ISM data and continued government infrastructure spending. Caterpillar, GE, and Honeywell are leading the charge. Financials. Modest gains thanks to higher yields, which improve net interest margins for banks. Losers. NVIDIA, AMD, and Microsoft all declined 2 to 4% this week, as rising yields made growth stocks less attractive. Consumer discretionary. Amazon and Tesla lost ground amid worries about consumer fatigue and a cooling labor market. Utilities, underperforming due to higher rates making dividend-paying stocks less attractive compared to Treasury yields. We're witnessing a classic rotation out of high-growth momentum plays and into cyclical and value stocks. That doesn't mean the tech rally is over, but it may be taking a breather. Part 4, technical breakdown. S&P 500 at a make-or-break zone. From a charting perspective, the S&P 500 is approaching a critical support zone. First support at 6,100, this week's intraday low. Stronger support at 6,150, near the 50-day moving average. Resistance levels, immediate resistance at 6,160. Breakout resistance at 6,200. The Nasdaq is showing more weakness. It has already broken below its 20-day moving average and is approaching the 50-day at 19,600. If that fails, we could see a move down to 19,000 RSI, Relative Strength Index. S&P 500 46 neutral zone, Nasdaq 43 trending lower. Momentum is clearly cooling, and if yields continue rising, we may see a further to 4% correction before bulls regain control. Part 5 Earnings Update. Q3 preview season kicks in. While Q2 earnings season is largely behind us, some companies are starting to release early Q3 guidance. Highlights this week: Broadcom beat earnings estimates but warned about slowing enterprise demand for semiconductors. Lululemon, Lulu, beat on EPS but cut full-year revenue guidance, citing cautious consumer spending. Oracle ORCL and Adobe ADBE report next week, both critical names for gauging enterprise IT and cloud trends. Overall, earnings growth for Q3 is projected at plus 6.2% year over year, according to FactSet. That would mark a second straight quarter of positive growth, a good sign. But guidance is trending conservative. Investors should brace for more volatility around earnings, especially in software and consumer discretionary. Part 6 Macro Outlook. September could set the tone for Q4. Here's a quick calendar of what's coming in the next 2 weeks. SEPA 6 Friday, August ISM manufacturing final and unit labor costs. SEP 10 Tuesday, NFIB small business optimism. SEP 11 Wednesday, CPI for August. This is the big one. SEP 12 Thursday, initial jobless claims. SEP 13 PPI inflation and consumer sentiment. SEP 18 FOMC rate decision. The CPI report next Wednesday will be the make or break moment. Markets are expecting headline CPI at 3.4% and core CPI at 3.9%. A surprise to the upside could erase hopes for a 2025 rate cut altogether. Meanwhile, rising oil prices, weakening consumer credit, and a tight labor market all suggest we're heading into a very complicated macro stretch. Part 7 What smart money is doing right now. So what are hedge funds and institutional players doing this week? Increasing energy exposure, buying oil majors and oilfield services, hedging tech, buying puts on the QQQ and XLK, adding to cash positions, waiting for a clearer entry point post FOMC, rotating into value and industrials. Retail investors should take notes. This is a positioning phase, not a chase the rally moment. Final strategy: how to prepare for the next move. Let's close with some actionable strategy. For active traders, don't chase breakouts unless S&P 500 closes above 6,200. Watch yields. If 10-year Treasury stays above 4.4%, tech will remain pressured. Play sector strength. Energy and industrials are leading for a reason. For investors, trim high multiple tech stocks if you're overexposed. Add to value names and dividend plays on weakness. Keep cash handy. A September dip is not a crash, it's an opportunity. If you found this breakdown helpful, make sure to give it a thumbs up and subscribe so you never miss an update. Drop a comment below with your take on the markets. I read every single one. Thanks for watching Daily US Stocks, where smart investors stay informed. See you in the next one.